Success in the financial markets is not a product of magic, luck, or some unknowable secret. It is the direct and unavoidable result of adhering to a clear and definite set of laws. The average person enters the market and treats it as a casino, a place of guesswork where fortune is dictated by chance. They consistently fail. The professional, however, approaches the market as a business, and like any successful business, it must be operated according to sound, unbreachable principles. William Delbert Gann, after a lifetime of scientific study and practical application, codified these principles into a set of 24 never-failing rules. These are not mere suggestions or helpful tips. They are the constitution for the professional speculator, a complete system of laws that, if followed without deviation, will ensure survival, protect capital, and ultimately lead to consistent profitability. This is the blueprint for transforming speculation from a gamble into a profession. Before we continue, please subscribe and leave a quick comment, even one word. This small action helps the algorithm show this video to more people and tells me these deep dives are worth making. The first and most critical group of rules laid down by William Delbert Gann forms what can be called the triad of survival. These are the foundational laws of capital preservation and risk management. Without a mastery of these first three principles, no strategy, no matter how brilliant, can lead to long-term success. They are the bedrock upon which a trading career is built. Rule 1. Amount of capital to use. The first law is the most important for ensuring your longevity in the market. Divide your capital into 10 equal parts and never risk more than 1/10 of your capital on any one trade. This is not a conservative suggestion. It is a mathematical imperative. The new trader, eager for large and rapid gains, often scoffs at this rule, believing it will slow his progress. This is a fatal error in judgment. The 10% rule is not designed to limit your profits. It is designed to guarantee your survival. The market will inevitably hand you a series of losses. No trader is correct every time. The question is not if you will have a losing streak, but when. The 10% rule is your mathematical shield against that inevitability. Consider the simple arithmetic. A trader who risks 50% of his capital on a single trade is only 2 consecutive losses away from being wiped out entirely. A trader who risks 25% is only 4 losses away from ruin. But the trader who adheres strictly to the 10% rule can withstand 9 consecutive losses and still have capital remaining to continue his business. This provides an immense psychological advantage. A loss, when it is a calculated and controlled 10% of your operating capital, is not a catastrophe. It is a business expense. It does not induce panic or cloud your judgment. You can accept the loss, analyze your mistake, and approach the next trade with a clear and objective mind. The trader who has risked too much, however, is crippled by fear after a single loss, making a rational decision on the next trade nearly impossible. William Delbert Gann understood that financial survival and psychological stability are inextricably linked. The 10% rule is the mechanism that ensures both. It forces discipline, removes the element of ruinous gambling, and is the absolute first step in treating speculation as a serious profession. Rule 2. Use stop-loss orders. The second law is the practical enforcement of the first. It is the mechanical tool that makes the 10% rule a reality. Use stop-loss orders. Always protect a trade when you make it with a stop-loss order 3 to 5 points away. A stop-loss order is a predetermined order given to your broker to close your position if the price moves against you to a specified level. It is the non-negotiable safety valve that ensures a small, manageable mistake can never escalate into a devastating financial blow. William Delbert Gann considered trading without a stop-loss to be unthinkable, a pure gamble on hope. He wrote, "If you cannot follow a rule, do not begin speculating or investing, as you are sure to lose. A strong willpower is just as essential as plenty of capital. If you have not the firmness, willpower, and determination to protect every trade with a stop-loss order, do not start trading, for you will fail. The stop-loss must be placed at the same time you make the trade. This is critical. At the moment of entry, your mind is clear and your decision is based on your analysis. If you wait to place the stop, you allow the destructive emotions of hope and fear to enter the equation. Once the trade is on, you will be tempted to give it a little more room, hoping it will turn around. This is the path to ruin. A common fear among new traders is that their stop-loss will be triggered at the exact low or high of a move, only to see the market reverse without them. William Delbert Gann acknowledged this possibility, but dismissed it as poor reasoning. He knew that 1 time out of 10, a stop might be caught at a perfect turning point. But the amateur fixates on this one instance and forgets the 9 other times the stop-loss order performed its duty perfectly, saving him from a major loss by getting him out of a trade that was fundamentally wrong. The purpose of the stop-loss is not to create a perfect exit. Its purpose is to enforce discipline and protect capital. It is your admission that you can be wrong, and it is your predefined plan for what to do when you are. It is the single most important mechanical habit a new trader can develop. Rule 3. Never overtrade. The third law of survival is a direct consequence of the first 2. Never overtrade. This would be violating your capital rule. William Delbert Gann called overtrading the greatest evil in Wall Street and the cause of more losses than any other factor. Overtrading is the compulsive need to trade too frequently or in sizes too large for your capital. It is born from impatience, greed, and a lack of a definite plan. After a few successful trades, the novice trader becomes overconfident. He abandons his strict capital rules and begins to increase his size, hoping to accelerate his profits. This is the moment his downfall begins. Overtrading is a mathematical trap. As William Delbert Gann explained in Truth of the Stock Tape, a trader who makes 1 trade per day for a year, paying commissions and costs, faces a massive 150-point handicap he must overcome just to break even. The patient professional, who waits for the major opportunities and makes only a dozen trades a year, faces a tiny fraction of that cost. Overtrading also violates the laws of probability. Every trade is a decision, and more decisions mean more opportunities for error. Beyond the mathematics, overtrading destroys a trader's most valuable asset, his judgment. The constant stress of being in the market, of watching every tick, leads to mental fatigue. The trader loses his perspective, unable to distinguish between the market's meaningless daily noise and a true change in the primary trend. His decisions become emotional and reactive rather than analytical and proactive. The cure for overtrading is a strict adherence to a definite plan. A trader with a plan knows exactly what setup he is waiting for. If that setup does not appear, he does nothing. He has the patience to sit on the sidelines, in cash, knowing that a position of no action is often the most profitable position to have. This rule is a command for discipline, a reminder that success is measured not by the frequency of your activity, but by the quality of your decisions. The laws of profit and loss. Once the foundation of survival is established, the next group of rules governs the professional management of trades, both winning and losing. These laws are designed to enforce the primary objective of any business, to maximize revenues and minimize expenses. In trading, this means cutting losses short and letting profits run. Rule 13. Never average a loss. The first law in this group is a cardinal sin of trading: never average a loss. This is one of the worst mistakes a trader can make. Averaging down is the act of buying more of a stock after it has declined from your initial purchase price. To the novice, it seems logical he is simply lowering his average cost. To the professional, it is financial suicide. Averaging a loss is the act of willfully reinforcing a mistake. Your initial trade was based on the analysis that the stock would go up. When it went down instead, the market gave you clear, immediate feedback. Your judgment was wrong. The correct response is to accept this feedback, close the position, and take a small, controlled loss as dictated by your stop-loss order. The trader who averages down refuses to accept that he is wrong. His ego is now involved. He is not making a new, objective decision. He is doubling down on his initial error, committing more capital to a position that has already proven to be incorrect. He is now trading on hope, not on facts. William Delbert Gann was adamant. If you make one trade and it starts to go against you, you are wrong. Then why buy or sell more to average a loss? It is a destructive path that clouds judgment and exponentially increases risk, often leading to a single catastrophic loss that can wipe out an entire account. Rule 4. Never let a profit run into a loss. The inverse of holding on to a losing trade is failing to protect a winning one. The fourth unbreakable law is, never let a profit run into a loss. After you once have a profit of 3 points or more, raise your stop-loss order so that you will have no loss of capital. More traders, William Delbert Gann noted, are ruined by violating this rule than almost any other. It is a failure born of greed and indecision. A trader enters a position correctly, and the market moves in his favor. He has a paper profit. At this moment, his primary objective must shift from seeking more profit to, first and foremost, protecting the profit he has already made. The practical application is simple and mechanical. Once a trade shows a reasonable profit, Gann suggests 3 to 5 points as a general guide, the original stop-loss order should be moved to the break-even point. This action is transformative. It instantly removes all risk of capital loss from the trade. The worst-case scenario is no longer a loss, but a scratch trade. This creates a state of psychological freedom, allowing the trader to hold the position with confidence and let the profit run, knowing that his initial capital is safe. As the stock continues to advance, he can then trail his stop-loss order behind the market, locking in a greater portion of the profit with each new upward swing. The trader who fails to do this, the one Gann called hoggish, watches a good profit dwindle on a normal reaction, hoping for one more push higher, only to see it cross his entry price and turn into a loss. This is poor business, and it is entirely avoidable through the disciplined mechanical application of this rule. Rule 15. Avoid taking small profits and big losses. This final rule is the logical and mathematical outcome of all the preceding laws of risk. Avoid taking small profits and big losses. This simple statement encapsulates the entire business model of a successful trader. It is the direct result of cutting losses short and letting profits run. The amateur trader consistently does the exact opposite. He is governed by fear when he has a profit and by hope when he has a loss. When a trade moves a few points in his favor, he is terrified of the profit getting away, so he snatches it quickly. When a trade goes against him, he hopes it will come back, so he holds on, allowing a small mistake to grow into a large, damaging loss. He ends the year with a high percentage of winning trades, but his few catastrophic losses wipe out all of his small gains and more. The professional, by adhering to the rules of William Delbert Gann, inverts this equation. By using a stop-loss order on every trade, he ensures that his losses are always small and predetermined. By never averaging a loss, he prevents these small losses from ever becoming large ones. By protecting his profits and trailing his stop, he gives himself the opportunity for his winning trades to grow into substantial gains. His goal is not to be right every time. His goal is to ensure that when he is right, he makes significantly more than he loses when he is wrong. This is the only mathematical formula for long-term success in the markets. It is the end result of a complete system founded on the unwavering discipline of capital preservation and risk management. Having established the foundational laws of survival, the non-negotiable rules of capital management and risk control that form the bedrock of a professional trading career, we now advance to the mechanics of profitable action. Once your capital is secure, you must have a clear and definite set of rules for strategy and execution. It is not enough to simply survive. The goal of a business is to generate profit. This next group of unbreakable laws from William Delbert Gann provides the strategic compass for navigating the market. They answer the critical questions of which direction to trade, what assets to trade, and how to execute your decisions with the precision of a master. These are the rules that transform a defensive posture into a profitable offense. The laws of strategy, direction, and selection. Rule 5 and 18. Follow the trend and embrace both sides. The first and most important strategic principle is Rule 5. Do not buck the trend. Never buy or sell if you are not sure of the trend according to your charts. William Delbert Gann viewed the market as a powerful river with a dominant current. He wrote, "If you were on a railroad track and saw a train coming at 60 miles an hour, would you stand there and hope that the train would stop before it hit you? Of course you wouldn't. You would get out of the way and do it quick. You should do the same thing in the stock market. To trade against the primary trend is to fight the market's most powerful force. It is a low-probability, high-risk endeavor that has destroyed countless accounts. The job of the professional speculator is not to be a hero who perfectly predicts the absolute top or bottom of a market. That is a game of ego and guesswork. The professional's job is to learn the scientific methods for identifying the established, dominant trend, and then to trade in harmony with it. When the primary trend is up, every pullback and correction is a potential buying opportunity. When the primary trend is down, every rally is a potential short-selling opportunity. This single principle, followed with unwavering discipline, aligns your trades with the path of least resistance and places the market's momentum at your back. This leads directly to the corollary law, Rule 18. Be just as willing to sell short as you are to buy. Let your object be to keep with the trend and make money. William Delbert Gann was astonished by the public's ingrained fear of selling short. He saw it as a psychological block that prevented them from participating in 50% of the market's major opportunities. He argued that a trader who only ever plays the long side is trading with one hand tied behind his back. He wrote, "What chance has a bull and bear years or years of panic and depression?" The historical record provides the clear answer. During the Great Bear Market from November 1919 to August 1921, stocks like Crucible Steel declined over 229 points, and Mexican Petroleum declined over 179 points. The trader who refused to sell short was either forced to stand aside for nearly 2 years, or far worse, was wiped out trying to buy the dips in a falling market. The man who embraced the short side and sold the rallies, however, was presented with one of the greatest profit-making opportunities in history. To be a professional is to be agnostic about market direction. Your only allegiance is to the trend. If the trend is up, you are a bull. If the trend is down, you are a bear. Rule 7 and 19. Trade active leaders, not low-priced laggards. Once you have determined the trend, you must select the proper vehicle for your trade. Rule 7 is a practical command. Trade only in active stocks. Keep out of slow, dead ones. The business of speculation, William Delbert Gann taught, is to trade for fluctuations. He stated, "Big money is made not from dividends but from fluctuations if you know how to trade quickly." Active leading stocks provide 2 essential ingredients for success: opportunity and liquidity. Because they fluctuate over a wide range, they offer greater opportunities for profit. If you take a small loss in an active stock, another opportunity to recoup that loss and make a profit will likely present itself soon. In a slow, inactive stock, your capital can be tied up for months or even years, dead money that is not working for you. Furthermore, active stocks provide liquidity, ensuring that you can enter and exit your position cleanly without significantly affecting the price. Inactive stocks often have wide spreads and thin markets, making it difficult and costly to get out when you need to. This leads directly to Rule 19. Never buy just because the price of a stock is low or sell short just because the price is high. This is one of the most common and dangerous fallacies among amateur investors. They are naturally drawn to low-priced stocks, believing them to be cheaper and to have less downside risk. William Delbert Gann taught that the opposite is often true. He wrote, "Never buy a stock just because the stock is low. There is usually a good reason why it is low, and it can go lower. A low price is often a sign of fundamental weakness, not of a bargain. Conversely, a high price is not in itself a reason to sell. A stock that is making new highs is in a strong position, and as long as the trend is up, it can continue to go much higher. Your decision to buy or sell must be based on a definite indication of a change in trend as shown on your charts, not on your personal opinion of what constitutes a high or low price. Trade the leaders, follow their trends, and ignore the deceptive lure of seemingly cheap, inactive stocks. To apply these strategic rules with a master's precision, you must learn to read beyond the chart and grasp the dynamics behind every movement. William Delbert Gann's Truth of the Stock Tape, 1923, is widely regarded as a foundational guide to this skill. It offers a practical course in interpreting the tape and market activity to understand the ongoing contest between buyers and sellers, recognize phases of accumulation and distribution, and assess the strength or weakness of a trend. This edition includes restored historical charts from the original. Their visual quality varies, but their documentary value is significant, offering a direct window into Gann's analysis. For serious students ready to move beyond surface lines and study the market's intent through tape reading and price behavior, this book is an essential resource. Get your copy through the link in the video description. The Laws of Execution and Advanced Tactics. Once your strategy is set, you must execute your trades with precision and manage them with professional discipline. This next group of rules covers the mechanics of trade entry, management, and the advanced tactics of a seasoned operator. Rule 9 and 10. Trade at the market and hold for a reason. Rule 9 is a command for decisive action. Never limit your orders or fix a buying or selling price. Trade at the market. When your system of rules has given you a definite signal to act, the time for hesitation is over. William Delbert Gann saw countless traders miss the beginning of a major move because they were trying to quibble over an eighth of a point, hoping to get a slightly better price. The market does not wait for you. When a stock breaks out of a major zone of accumulation, it will often move quickly. To miss the entry in an attempt to save a few cents is a catastrophic error that can cost you a potential profit of many points. When the signal is given, act at the market. Once you are in a position, Rule 10 dictates how you manage it. Don't close your trades without a good reason. Follow up with a stop-loss order to protect your profits. The only valid reason to close a trade is because your analysis indicates that the trend has changed. Closing a position simply because you have a small profit is a common mistake born of fear. You must have the patience to let your profits run as long as the trend is in your favor. The way to do this without succumbing to anxiety is to use a trailing stop-loss order. As the price moves in your favor, you systematically move your stop up behind it, locking in a portion of your gains and giving the stock room to have its normal reactions without stopping you out prematurely. Rules 20, 21, and 22. Pyramiding, selection, and hedging. For the advanced trader who is operating in harmony with a strong, confirmed trend, William Delbert Gann taught the powerful technique of pyramiding, or adding to a winning position. Rule 20 provides the critical caution. Be careful about pyramiding at the wrong time. Wait until the stock is very active and has crossed resistance levels before buying more. Pyramiding is an aggressive tactic that should only be employed when a trend is well established and showing exceptional strength. To add to a position too early, before a major resistance level has been cleared, is to increase your risk unnecessarily. Rule 21 provides further guidance on selection. Select the stocks with small volume of shares outstanding to pyramid on the buying side and the ones with the largest volume of stock outstanding to sell short. The logic is sound. A stock with a small number of shares, a small floating supply, requires less buying power to move up. Once it breaks out, it can advance very rapidly, making it an ideal vehicle for pyramiding. Conversely, a stock with a very large capitalization is nearly impossible for a single group to corner, making it a much safer candidate for a short sale. Finally, Rule 22 forbids a common practice born of indecision. Never hedge. If you are long of one stock and it starts to go down, do not sell another stock short to hedge it. Get out at the market. Take your loss and wait for another opportunity. Hedging is an admission that you have lost clarity. You are holding one position based on the belief the market will go up, and another based on the belief it will go down. This is a state of confusion. The professional response to a trade that is going wrong is not to add a conflicting position, but to admit the mistake, take the small controlled loss, and return to a state of clarity on the sidelines. We have now established the first two pillars of the Gann methodology: the foundational laws of capital preservation and risk management, and the mechanical rules of strategy and execution. A trader who masters these principles has built a formidable fortress to protect his capital and a clear set of tactical plans for engaging the market. Yet even with the strongest fortress and the best battle plans, victory is not assured. There is one final internal battlefield that every trader must conquer: the battlefield of the mind. William Delbert Gann understood that the greatest enemy to a trader's success is not the market, but himself. This final group of his 24 never-failing rules is therefore dedicated to the most challenging and most important task of all: achieving the discipline, patience, and mental clarity of a master. The laws of psychological discipline. Rules 6, 14, 16, 17, and 23, the foundation of mental control. This group of rules is designed to govern your internal state, to build a mental framework that is impervious to the destructive emotions of the market. The first command is Rule 6. When in doubt, get out, and don't get in when in doubt. This is a mandate for clarity. William Delbert Gann knew that profitable decisions can only be made from a state of confidence and certainty. Doubt, confusion, and hesitation are signals that you have lost your analytical edge or that the market itself is in an unpredictable state. To remain in a position while in a state of doubt is to subject your capital to the whims of a compromised mind. He taught that a position in cash is not a missed opportunity. It is a position of strategic safety, allowing you to observe the market with an unbiased eye and wait for a setup that is so clear it removes all doubt. This leads directly to Rule 14. Never get out of the market just because you have lost patience or get into the market because you are anxious from waiting. This rule attacks the twin demons of impatience and anxiety. The professional trader acts only when his rules give him a definite signal. The amateur acts because of an internal emotional pressure. He gets tired of waiting and forces a trade that isn't there, or he gets frustrated with a slow-moving trade and abandons it just before the real move begins. This rule is a command to base every action on the market's own timing and signals, not on your internal emotional state. To enforce this discipline, Rule 16 is absolute. Never cancel a stop-loss order after you have placed it at the time you make a trade. Placing a stop-loss order is a rational, premeditated decision based on your analysis. Canceling that stop is almost always an emotional act, a surrender to hope. It is the moment a trader abandons his business plan and starts gambling that the market will save him. William Delbert Gann saw this as a fatal error. He knew that the market has no obligation to rescue a bad decision. Adhering to your initial stop-loss is the ultimate act of discipline, the moment where your predetermined rule must conquer your in-the-moment emotion. Rule 17. Avoid getting in and out of the market too often, reinforces this theme. Frequent trading is a symptom of impatience and a lack of a clear plan. It leads to mental exhaustion, a loss of perspective, and the accumulation of losses from commissions and small errors. It is the opposite of the professional's patient approach of waiting for the rare, high-probability opportunities. Finally, Rule 23 synthesizes all of these principles into one master command. Never change your position in the market without a good reason. When you make a trade, let it be for some good reason or according to some definite plan. Then do not get out without a definite indication of a change in trend. Your every action, from entry to exit, must be justified by your rules, not by a whim, a tip, or an emotional impulse. The laws of the business mindset. The final group of rules elevates the trader from a mere speculator to a true business professional. They govern the mindset required to manage trading not as a series of individual bets, but as a long-term sustainable enterprise. Rule 11. Accumulate a surplus. Rule 11 is a cornerstone of professional business management. Accumulate a surplus. After you have made a series of successful trades, put some money into surplus account to be used only in emergency or in times of panic. The amateur trader, after a series of wins, immediately increases his trading size, often recklessly. The professional, however, understands that losses and drawdowns are an inevitable part of the business. By systematically moving a portion of his profits into a separate surplus account, he builds a capital buffer. This surplus is not to be used for aggressive everyday trading. It is a reserve fund that ensures the business can withstand a period of losses without impairing its core operating capital. It is the mark of a mature, long-term perspective. Rule 12. Never buy just to get a dividend. Rule 12 addresses a common misconception that traps many investors. Never buy just to get a dividend. William Delbert Gann taught that a trader's primary focus should be on capital preservation and profiting from fluctuations. He knew that dividends are often a deceptive lure. A high dividend yield can make a stock seem attractive, but it is often a sign of underlying weakness, a lure to attract buyers into a stock that insiders are distributing before a major decline. He wrote, "Look to the protection of your capital, not for dividend returns." The history of the market is filled with examples of high dividend stocks that have collapsed in price, wiping out far more in capital than they ever paid in dividends. A dividend should be considered a secondary benefit, never the primary reason for entering a trade. Rule 24. Avoid increasing your trading after a long period of success. Finally, Rule 24 is a master-level rule of psychological self-awareness. Avoid increasing your trading after a long period of success or a period of profitable trades. This rule addresses the great danger of hubris. After a winning streak, a trader is at his most vulnerable. Overconfidence sets in, and he begins to feel invincible. This is when he is most likely to abandon the very rules that made him successful. He starts taking larger positions, ignoring his stop losses and trading with less preparation. This rule is a command for humility. It is a reminder that success is temporary and that the market will quickly humble anyone who loses respect for its power. The professional maintains the same level of discipline, caution, and adherence to the rules during periods of success, as he does during periods of loss. These 24 never-failing rules are not a collection of disconnected pieces of advice. They are a single, interconnected, and complete philosophy for professional operation in the financial markets. They form a system where each rule supports and reinforces the others. The rules of capital management provide the foundation for survival. The rules of strategy and execution provide the plan for profitable action. And the rules of psychology and discipline provide the mental fortitude to execute that plan flawlessly, free from the destructive influences of hope and fear. The difference between the successful speculator and the failed gambler lies not in their intelligence or in some secret formula, but in their unwavering discipline to follow a set of unbreakable laws. William Delbert Gann dedicated his life to discovering and codifying these laws. He proved that the market is not a place of chaos, but an arena of cause and effect, governed by scientific principles. For the trader who is willing to do the work, to study the rules, and to master himself, these 24 principles are the definitive blueprint. They are the path to transforming speculation from a game of chance into what he rightly called it, a profitable profession.